High yield dividend stocks. That's what I'm going to cover in the video today. I want to cover 10 positions in my personal portfolio of 51 stocks that are offering compelling starting dividend yields right now, because I am actively looking right now to increase the passive income that's coming from my portfolio. And one of the reasons I'm focused on high yield right now, quite frankly, is I just interviewed my friend Greg in the two-part video series. I will link to those in the pinned comment below. Greg just retired off of dividends and passive income. He did it at a young age. He's similar in age to me. It's so exciting to see his accomplishment. And one of the ways that he did that is he's focused on higher yielding dividend stocks and higher yielding passive income investments. Greg suggested to me this book called The Income Factory by Stephen Bavaria. Frugal hack, by the way. My wife was able to check this out from the local library for me. I'm about 1/3 through this book right now, and it's really awesome. I like it. It's a really good read. And so in my interviews with Greg, also in my just reading of this book, The Income Factory by Stephen Bavaria, this point is starting to solidify in my mind a little bit that there's a lot of comfort, a lot of value in these higher yielders that just pay the dividends right now, because I don't have to wait for them to increase the dividends. I don't have to wait for their businesses to thrive, their businesses to grow, to earn more income so that they can pay me more as a shareholder. These higher yielders right now, they're already earning the income. They already have the fundamentals to pay those higher yields right now. And so there's a lot of value in that. That's one of the points that this author makes in this book. Although my strategy, it's a little bit more focused on dividend growth investing, or quite a bit more focused on dividend growth investing than Mr. Stephen Bavaria's. That being said, I can draw on elements of this book to hone in and fine tune my own investing strategy. But I'm so excited today because I want to go through my analysis, how I looked at my 51 stock portfolio, and how I found 10 of those stocks that I'm compelled to purchase right now for some higher dividend yield. Get ready, everyone, for a really exciting dividend stock investing video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone, I'm so excited to get started. Before I get started today, if you enjoy these videos here on YouTube about dividend stock investing, passive income, please go ahead and click that like button. Believe it or not, I don't earn too much money from this channel at all. The money that comes in basically covers the costs of equipment and supplies to run this channel. I do this as a labor of love. It's a passion of mine. I enjoy doing these videos. I enjoy connecting with those in the community. And one of the best ways that you can thank me for producing these videos here on YouTube is by clicking that like button and sharing this channel with your friends if you think anyone could benefit from these videos about dividend stock investing. I want to start with my process, with my strategy. Check it out on the screen in front of you right now. This is what I'm going to go through in the process in the video today and what I did earlier today at home. Basically, I went through my entire stock portfolio. I started looking for stocks that have a starting dividend yield greater than 3%. I know that's not high yield for a lot of people, but in the sense of my greater dividend stock portfolio, 3% or higher in this market, that's kind of higher yield for me. Although obviously Greg was speaking in the videos about his higher yielders yielding upwards of 9%. I combed through those stocks. I'm trying to look for the ones that make the most sense. There were a lot of stocks that came up in my analysis that were yielding over 3%. In fact, I went through a good 20 plus stocks. I'm actually going to cover all of those in the video today. But I started looking through them and I tried to understand, well, is it in a strategic sector? Is it presenting value right now? Is it a core stock or ancillary? Obviously, if the stock is a higher yielder in my portfolio and it's in a strategic sector and it's presenting value and it's a core stock and not necessarily ancillary, those are the type of positions that I'm looking to add to right now. And then I created a final list of the stocks that offer high current yield with a low to moderate level of risk, in my personal opinion, and some level of dividend growth, perhaps 5% compound annual growth rate over time. That's the process that I underwent earlier today. That's the process that I want to go through in the video today to share with all of you at home how this classical dividend growth investor can pull elements of high yield investing into my own strategy, even though I'm not necessarily a high yield investor like Greg or like Stephen Bavaria. I can still gain a lot of insights from them and implement it right now in what I'm doing in baby steps. And who knows, in the future, I may draw on some of those other high yield concepts that Greg shared with all of us. But this is a starting point for me. So check it out on the screen in front of you right now. This is a massive table of the positions that I started going through. You're actually going to see in this first table, I've got 22 stocks, but I was able to basically consolidate this list down to about 10 stocks that I am interested in buying right now. By the way, my patrons, I'll link to this in the pinned comment below. Over on Corner Patreon, I will upload this spreadsheet over on Patreon. But if you're interested in Patreon, I have some cool perks over there. It's a awesome place to be. Check it out. And so anyway, the first stock that I found was Hasbro. It's a consumer discretionary. I like this stock right now because based on the earnings estimates, it's trading at a forward PE in the 12s this year, 11s next year. It's exciting to see that. And I love the current dividend yield, starting dividend yield of 4.67%. At 4.67%, quite frankly, in the scheme of my portfolio, I don't really need Hasbro to increase the dividend at all. That is a fine yield in perpetuity for me, although thankfully Hasbro over long periods of time has tended to increase its dividend, and the payout ratio is only 59.4%. Now, what's interesting, if you look all the way in the first column, am I going to buy more of Hasbro or not? I said no. One of the reasons is that it's ancillary. The other more important reason that I'm not buying more Hasbro right now in my personal account is I am buying that in both of my kids' accounts because they both love Hasbro toys. And for holidays like Christmas, Merry Christmas, everyone, and for birthdays as well, I like to buy them the gift of stock. I think that's a much better gift than material objects, and it's a great way to educate them on taking control of their personal finances at a young age and hopefully doing even better in life than I've been able to do because I've made every mistake in the book. I'm trying to teach them to avoid a lot of the pitfalls that I've faced as an investor over my lifespan. And so anyway, I'm not going to be buying more for my personal account, but for my kids, that's one that I'm buying right now. I kind of look at things family-wide because, quite frankly, the portfolio I'm building is generational in nature. The portfolio my wife and I are building, it's our portfolio. The one we're building, it's generational in nature. And so eventually, it's something we want to pass on to future generations, to the kids. And so I kind of think of things that way holistically across our accounts and kids' accounts, so on and so forth. And that's why I look at it that way. But I got to keep going because I got a lot of ground to cover. Check it out on the screen right now. I'm not going to go through every metric for every stock because we just don't have the time today. But the second stock that came up was Kimberly-Clark. That's a clear yes for me. I want to buy more of it. I don't like the high PEs in the 24 this year, 21 next year. I do like the starting yield of 3.34%. I would say it's definitely not a value, but it's a core stock for me. It's strategic in nature. And quite frankly, I haven't been buying a lot of CPG, consumer packaged goods stocks for a while. I've neglected them. I'm ready to buy them back or with an increased cadence a little bit. And I set myself a rule a number of years back that I'm just going to go ahead and buy my core stocks, each of them at least once a year. And I don't think I've been buying any Kimberly this year other than reinvesting dividends. So that's kind of a higher yielder in my portfolio that I'm comfortable buying now, even though it is at a fair, if not overvalued PE for strategic reasons and for reasons of it being a core stock. So that's the first one today that is a clear yes for me. Let's keep going. As you can see on the screen in front of you right now, the third stock that I want to cover is Clorox. Basically, I don't need to go through this one in too much detail. The conclusion I had was the same as Kimberly. It's not a value right now. I think the PE is a little misleading. It's a little better off than the PE would suggest because earnings will catch up. I think there's still people working through their back stock of Clorox products. I know we have quite a back stock of Clorox products in our pantry and in our garage. But nonetheless, I think that this one is a compelling stock for me right now at a 3.19% starting dividend yield. And quite frankly, that payout ratio being over 100%, I also think that's misleading because I think their earnings will rebound over time. They're still facing kind of post-pandemic people just having back stock of Clorox products and kind of catching up with with their back stock and then finally replenishing that. I think it will happen over time. But again, this isn't a value, but it's a strategic category for me, CPG. It's also a core stock, which I've neglected and I haven't added to much this year at all. So I'm happy to think about adding a little bit more of Clorox. But Kimberly and Clorox, quite frankly, are not values. You will see some value, though, later in the video today. Let's keep going. Check it out on the screen in front of you right now. It's funny how I reach these conclusions because you can see I kind of skipped over Hasbro, which is the value, but I decided for myself, at least, I'm only speaking of my personal financial journey here on YouTube. It's possible to lose money in the market. I'm just sharing my personal journey. You can see from my personal journey why Kimberly and Clorox make sense, but Hasbro does not as of this time. Altria is the fourth stock I want to cover today. That is a clear yes for me. This one, quite frankly, is trading at a PE of 9, and it has a starting yield of almost 8%. The way that I look at Altria is it's not quite, I'd say, a core stock, but it's up there. It's almost a core stock for me. But what I see there is I see value. Is it a strategic category for me? Absolutely not. I want to keep my sin stock exposure down, but because it has such a high yield, because I'm familiar with the company and I believe that the yield is sustainable and that it will grow over time, slowly though, probably from here on out. What I like about it is I don't have to buy it in too large of quantities, small amounts of Altria for me, because it carries such a huge yield at 8%, almost 8%, it lifts up the entire average. So small buys of Altria can really make an impact portfolio-wide for me when I look at income from a portfolio level. Let's keep going. As you can see on the screen in front of you right now, the next one I want to cover is BTI, another sin stock. By the way, if you can count up how many times in the video today I say, as you can see on the screen, put it in the comments below. I know some of you get frustrated with that, but it helps me edit these videos and just get through it all. I do all of this on top of my real job. Again, as I mentioned, these videos don't really turn too big of a profit for me. When I look at it on an hours invested standpoint, most people would say I'd have to be crazy to do it, but I do it because I love the community and I enjoy what I do here. But anyways, that's an editing hack for me. That's why I say that over and over. It just optimizes my time. BTI, quite frankly, is a similar story to Altria in terms of the metrics, but the reason it's a no for me, it's not on my buy list, is several-fold. First, I have a huge allocation to it already. Second, there was some kind of drama going down in California. I don't live there anymore, but California is basically saying that they're going to ban menthol in the products that are sold by heavily by BTI. And so with that particular company, given that they have exposure to some of those flavored products like menthol, because they acquired Reynolds American, they acquired Lorillard, because of all of that roll-up of the industry under BTI, I have a little bit of concern there. And so if I have the choice between buying Altria or BTI right now, just for me strategically, Altria makes more sense. That's why I put no for BTI, although the metrics are somewhat similar to Altria's. Let's keep going. As you can see in front of you right now, the next one I'm going to cover is Philip Morris. That one's a no for me, even though the starting yield is okay at almost 5%. It's 4.99%. It's just not quite high enough. And the PE is a little higher for that industry in the 18s. It's just not quite high enough for me, given the risk that's in that industry. I'd rather, if I were allocating money to sin stocks, put it in Altria. And Philip Morris, I have a similar story to BTI that I already have a huge allocation to it. One of the reasons I'm going through the video today is I want to show all of you at home my thought process. Yours will probably be completely different than mine because we're all different investors. I'm just sharing my own journey here for fun and entertainment. But you can kind of see how I approach things as an investor. And I just hope it helps people at home understand how maybe they could approach things. And maybe it's different than I do, but at least seeing the types of thought process that I go through. I want to keep going. I want to go into the energy sector. As you can see in front of you right now, energy sector for me, I'm going to go through 3 in a row here. BP, Chevron, and Shell. All of them are no's. Although, quite frankly, all of these companies are doing really well right now from a PE standpoint. I mean, look at that. BP as a PE in the 3s and 5s. Chevron 9s and 10s. Shell in the 5s. Those PEs, though, are at a cyclical high for this industry. This is an industry that's highly cyclical. I want to buy these stocks when they're at cyclical lows and not when they're at cyclical highs. And funny enough, when these stocks tank and the price of oil, if it ever comes back down, those PEs will be sky high. This is the kind of industry where I want to buy it when the PEs are high, not when the PEs are low, because it's very cyclical, and these stocks have rebounded quite a bit. They're up trading at higher levels. And so despite the dividend yields being really high, like at 4.15, 3.28, and a 3.53, those are solid dividend yields, and the PEs appear really low, and they are. But for me right now, I'm not a buyer in energy. I will be when they come on correction again. And so energy industry is a no for me right now. Although I know a lot of investors find compelling value there in energy right now. Put in the comments below if you're an investor and you're actually buying energy stocks right now. Oil super majors like I own, for example. I'd be curious to know. Now, the next one is kind of a sin stock, but it's also a farming company. It's a yes on my list. Check it out in front of you right now. This one is an ancillary position, but the reason it's a yes on Universal Corporation is it gives me diversification. It's a small cap in my portfolio, and so I see value in that. I guess it would be strategic from that standpoint. And I just love the metrics. I see it as a value. So for Universal, I was only able to get trailing 12 months metrics, but I get a 14.84 in the PE, and I get a solid starting dividend yield of 5.95%. Payout ratio is 88%. I like this company. I just kind of feel like I've neglected it for a while. It's not core, it's ancillary, but I know it well. And this is one of the themes I want to resonate with all of you today. For me, it is so much easier to take a kind of a stroll down memory lane and look at all of the positions that I own in my portfolio and pick the higher yielders if I want more yield versus bringing net new into the portfolio. Because if I bring net new into the portfolio, I know the nth stock that I pick oftentimes is not as the same quality as the stocks I already own, and I'm comfortable with what I own. And so that's why I'm taking this journey, and I'm finding stocks in my portfolio like Universal that I know really well that can give me an almost 6% starting yield that will boost my portfolio-wide dividend yield. If you like high yielders, please go ahead and click the like button. And don't forget, by the way, to subscribe. I have new videos on the way all the time. Let's keep going, everyone. As you can see on the screen right now, the next one, keep counting, is Bank of Montreal. This one is a clear yes for me. Boy, I have underexposure to financials big time in my portfolio. It's something that I'd like to improve upon over time. I think with higher interest rates, these financials will do all right. And I like that BMO has a PE ratio in the 8s. That's, you'd never expect a higher PE from the banks the way you'd see perhaps from an industry like technology or an industry like CPG or an industry like really any of the others on this list perhaps. But, an 8, I would say, or 8 range for Bank of Montreal, I'm fine with that. I love the starting yield in the 4.68%. I love the lower payout ratio. And what's interesting is, speaking of market cycles, you would think right now that the banks are taking off, and maybe some of them are, but when I look at the stock chart for Bank of Montreal, it has not taken off yet. I think it's in a trading range that I feel comfortable with. So I think the trends are in favor of these financial institutions right now at the higher rates. I think that will help margins at Bank of Montreal and improve their financial fundamentals. But the stock hasn't really reacted yet. The PE, though, is coming down. I like to see that, and I definitely would like to buy more Bank of Montreal. Now, being a Canadian company, I will pay these foreign withholding taxes, but because I'm based in the U.S., I work hard. I have W-2 income coming in. I have income coming in to me, and I have to pay taxes. On the tax return, I'm able to claim back that foreign tax withheld as a credit. And so that's something, of course, I'm not offering tax advice. You want to go ahead and speak to your personal tax advisor for anything regarding your taxes. But for my tax situation, I don't worry about foreign tax withholding the way that a lot of people do. Now, if I were in fire, especially a lien fire, perhaps I were bringing in income that did not even qualify me to pay taxes, then that's a different thing. The foreign tax withholding, I don't know how that would all work out with taxes. But again, for me, because I'm filing, and I always be filing, quite frankly, for taxes, that's something at least that doesn't dissuade me from companies like Bank of Montreal, Canadian companies. I'm not worried about the foreign tax withholding. And again, I'm only speaking to my personal situation, but I want to give these nuances because it helps tell the story. Let's keep going. As you can see in front of you right now, the next one I want to go through is Bank of Hawaii. It's a no. The reason it's a no, quite frankly, is it just felt a little more expensive than Bank of Montreal, and the yield was a little bit lower. The next one is Viatris. This one is a no. Really, I don't have anything against Viatris, but I think it's actually a solid value here. I like the starting yield being at a 4.26%, but I love the PE. It's a value, but I have enough allocation to it. I'm fully allocated to it. It's an ancillary position. It's an ancillary position that I don't really want it to graduate higher in the portfolio. Whereas Bank of Montreal, quite frankly, I wouldn't say it's core, but it's kind of a proxy for core. It's like maybe... would I mind that being a top 20, top 30 stock in the portfolio? No. Would I mind Viatris being in my top 20? Yes. I don't want it to be. I love it, but it's one of the players on my team of 51 stocks. But it doesn't need to be in the top 20, top 30. That is for sure. And so that is how I make these types of decisions as I'm going through these stocks. The next one, as you can see, is AbbVie. No way I'm buying more AbbVie here. I just can't bring myself to do it. It's only yielding 3.63%. When I first started buying this, I think the yield was in the 7% range. I can't bring myself to buy AbbVie at these PE multiples that it's at. 11s and 14s. It just seems a little higher given than where I'd want to buy AbbVie, given their debt level and that Humira is coming off of patent protection in the U.S. And I know Skyrizi will pick up some of the slack on that, I believe, I hope, but we shall see. But I don't feel like buying more. I have a good allocation to AbbVie, and I bought at so much lower levels. I can't really bring myself to average up here. But on Pfizer, quite frankly, it's a clear yes. I actually plan on probably buying more Pfizer tomorrow. I like Pfizer here. It's a controversial stock, but sometimes I enjoy investing in controversy. I know that it's a polarized topic with the products that they produce, but over the last few years, they've really shored up their balance sheet. I think the company is in much better financial shape than they've ever been. I like the fact that their PE 2022 forward in the 8s is not maybe realistic because these products they sell, they're centered around pandemic era. That era will pass, but a stabilized PE, say in 2023 at 11. Hey, I like that range, especially as compared to AbbVie's 14. I see a more compelling value at Pfizer. Their dividend growth is lower. They're doing that because they don't want to appear that they're profiting off of hard times in our world. So I understand why they're raising the dividend a little slower, but that payout ratio is only 25%. Sooner or later, they'll probably increase it. I love the 3% starting yield. I see value. I see a lot of value at Pfizer now. I think there's some risk with it as well, but I'm comfortable with it. I plan to buy more Pfizer. And I would say, again, it's in the ancillary side of things in the portfolio, but it's a bigger ancillary position. So when I kind of look at my portfolio, I've got core, and then I've got everything else, which I call ancillary. But within ancillary, it's a universe of stocks. And there's certain stocks within ancillary, like Bank of Montreal or like Pfizer. I'm happy to have them a little bigger. There's certain stocks in ancillary, like Viatris, where I'm fine having those on the long tail of ancillary. But I want to keep going. As you can see on the screen in front of you now, the next one I want to cover is Leggett Platt. I just kind of forgot about this stock, and for a while I just did nothing with it. But I looked at the 5-year chart. It's kind of gone nowhere, and these are the kind of things that Stephen Bavaria looks for. It's nice to have a stock that goes nowhere, but it's sure chugging along and paying that nice dividend yield of 5.31%. 5.31% for me is meaningful. It lifts the portfolio wide. It's something I could use. I like the smaller cap diversification with Leggett. I like the PEs and the 14s and 15s. I think their bed springs and specialty products that they do with furniture and industrials overall could hopefully continue to do just fine. I think our travel industry is really seeing a resurgence. I'm seeing that with airline statistics, with airlines having more traffic, more volume than ever before, than in 2019 even. And so I imagine hotels will have to continue to refurbish their bedding and their bed springs and their mattresses, and Leggett is at the forefront of that. I think they'll be just fine. I'm going to buy some more Leggett. Now, I do want to clarify with everyone, am I abandoning my core stock strategy? No. This video is about bumping the yield in my portfolio a little bit because I was inspired by Greg and Stephen Bavaria. I'm going to do this on a more limited scale. I want to buy the 10 stocks that are yeses today, but quite frankly, is it going to be my core strategy? No. Of course, my core stocks, the corest holdings I have, my patrons already know this, but those are the ones I'm allocating more funds to, the most funds to week in and week out. But I don't want to forget these higher yielders because I could use some higher yield. It really helps. I'm already using some of my dividends to help pay bills. Let's keep going though. As you can see on the screen now, in addition to Leggett Platt, I have another industrial 3M. I've come to the realization that I'd be fine buying more 3M here. I'm not really concerned about the risk so much. There's so much risk with anything in life. And this is my personal journey. Of course, there's probably many people watching where the risk of 3M is not appropriate. But for me, it is. The forward PE in the 12s and 11s, I'm all about it. It's one of the largest positions in my portfolio. This is a core stock. This is a heavy core stock. This is a top of the top 10 list core stock for me, but my patrons already know that. Starting yield of 4.76% is meaningful. I already have a big allocation to it, but I'm fine to do more. So I'll be adding to some 3M. I've just kind of reached that conclusion. I wasn't there a month ago, 2 months ago. I'm there now. I want it. And I feel good about it. And so that's where I'm at with 3M. With Realty Income, surprisingly, the next one, as you can see on this screen, I say no. And the only reason I really say no is I actually think it's trading at a reasonable price to AFFO. That's a projection on AFFO for 2022. 4.6% starting yield is meaningful for me. It could help my portfolio. But the reason I skip Realty and I don't plan on buying more Realty right now is I just have exposure to real estate outside of the dividend portfolio, and I don't want to be overexposed to real estate. I like diversifying outside of real estate. So strategically, it's not for me. Do I see value there? I see a little. Is it a core stock for me? It kind of is. It's not in the core stocks, but it's up there. But is it strategic for me? The third pillar? Not really. And strategic here is really kind of canceling out everything else. It's just not strategic for me right now, so Realty doesn't make sense, but I could see how it might make sense for other investors out there. I want to keep going. As you can see on the screen in front of you right now, the next one I want to go through is IBM. It's a clear no. I think IBM, I'm not really excited about it. I probably have too much money in it. Dividend yield is a solid 4.42%, which is meaningful for me. I'm excited that this stock's been doing pretty well. It's been climbing in share price. It's kind of gone against the trend during these kind of weird times for tech and for FANG stocks and for those kind of things. It's done all right, but just strategically speaking, I see some value there. I see a nice yield, but again, strategy, kind of like with Realty, it's just kind of canceling everything else out. I just can't see myself buying more IBM. And that's what's fun about investing is it's not, for me at least, only about the numbers. It's also about what my gut is telling me to do. And maybe that's bad. Again, just sharing my journey. I could be wrong, but for me at least, I've developed some intuition. And for dividend stocks, at least from a portfolio standpoint, I don't see any value for me in having more IBM, but I'm happy to hold what I have. Check it out on the screen in front of you right now. I want to close out the video today with some utilities. I got Southern, Hawaiian Electric, and Duke. I'll give you the quick lowdown on these. I see some kind of vague level of value. Maybe rather than value, I should say they're kind of fairly priced. Who am I kidding? These things, honestly, they're not great bargains by any means. I'd say Hawaiian Electric of the bunch is the one I feel less comfortable buying because I started buying that thing in the low 20s and I just don't feel great buying it in the 40s. So Hawaiian Electric's kind of out for me, and also just the lowest yield of the bunch. But Southern at a 3.84% yield, Duke at a 3.89%. I'm fine buying some of those here, quite frankly, for two reasons. It comes back to strategy. These are kind of core plus stocks. They're not in the core of the portfolio, really, but they're kind of real close behind. I love these stocks, Duke and Southern. I've been talking about these. Shout out, by the way, put in the comments if you've been here since those early days on this channel when I was analyzing Southern, when I was like walking around the streets of San Francisco with my selfie stick and talking about Southern. I remember that like it was yesterday. It's so funny how time flies, and since then, a lot has changed. But what hasn't changed is I still own Southern, and it's done well for me. And they overcame all the challenges that people were so worried. Back then, people were saying, Ian, don't buy Southern. They have this power plant, this nuclear power plant they're working on, and things are going bad. There's all this drama. I looked into it, and I knew there was risk, but I bought it anyways. It was calculated risk. It worked out for me. But it just goes to show, the other thing I'd say is, why do I give my kids kind of the gift of stock for Christmas versus, well, they get presents too, but for me, stock is so much more important, because I can tell you back when I was YouTubing about Southern, I was probably buying some things, material objects back then. I can't even remember what it was. I might not even own that stuff anymore. It might have lived its useful lifespan. It might have faced full depreciation, if you will, 100% gone. But you know what I still have? I still have the Southern shares that I bought. And you know what? They're worth more than when I bought them. And you know what? They're spinning off more cash flow than when I bought them. There are so few things in life that one can accumulate that it's actually kind of a good collection versus just junk or depreciating assets. And so it's so exciting to see that. But anyways, I feel like being core plus stocks, trading at okay PEs, trading at good starting yields for this market. And quite frankly, I haven't seen Duke and Southern rally as much as I would have thought they would. I see it's kind of like the bank stocks, like Bank of Montreal. I see some upside there on the share prices. But what's fun, as you can see on the screen right now, I'm going to share a different chart. This is a summary of what I'm buying. And when I look at the averages at the bottom, the PE this year is a 16, next year 15.9. So, hey, they're okay PEs. But what I love is the starting yield, if I just do a simple average, is 4.6%. That's what I'm after. Portfolio ride right now on my 51 stocks. I don't have the number in front of me, but I'm probably around a 3.2 or 3.3. Probably more like a 3.2 or 3.15% because the market has rallied quite a bit. So for me, if I make some trades and I buy some of these higher yielders that are strategic or kind of core plus in my portfolio at a 4.6%, it lifts my overall 3.2% yield of the portfolio. And yeah, this isn't doing high yield like Greg. It's not doing high yield like Steve in Bavaria, but it's taking insights from these great investors who I can learn from. And it gets me thinking in terms of generating more yield. And who knows, maybe I will venture out and do something else in terms of supplementing the yield in my portfolio. I look forward to seeing you in the comments below. It's always fun. And before I leave today, in terms of a full disclosure, this is going to be a long one, but I do own the stocks mentioned today, all of them. Oh my goodness. I own Hasbro, ticker HAS, as do my kids. I own Kimberly-Clark, KMB, Clorox, CLX, Altria, ticker MO, BTI, ticker BTI, Philip Morris, ticker PM, BP, ticker BP, Chevron, ticker CVX, SHEL, ticker SHEL. I own all of those. I also own Universal Corporation, UVV, Bank of Montreal, BMO, Bank of Hawaii, BOH. I own those stocks. I also own Viatris, VTRS, AbbVie, ABBV, Pfizer, ticker PFE, buying into that controversy. Leggett Platt, ticker LEG. 3M, more controversy, buying into that one, ticker MMM. I also own Realty Income, ticker O, IBM, ticker IBM, Southern Company, ticker SO, Hawaiian Electric, ticker HE, and Duke Energy, ticker DUK. I own all of those stocks in my personal dividend stock portfolio. Also, before I go, today's video, it is not investment advice. I'm not a licensed investment advisor. I'm just sharing my journey here on YouTube for fun and entertainment. It's possible to lose money in the stock market. And so it's important to consult with your own financial advisor before making any investment decisions. I have a full disclosure and disclaimer always in the description below as well. I'm just sharing my journey here on YouTube for fun and entertainment. It's possible to lose money. But I hope you enjoy following along and enjoyed the video today. I love you all. I'll see you in the comments below, and I'll see you in the next dividend stock investing video.